Despite a decade of proof points, European pensions still allocate only marginally to European venture, not because of returns, but because of structure and coordination. Professor Philippe Tibi has worked inside that gap, pushing Europe's largest institutions to move. Today, he lays out why LP fragmentation is now a strategic weakness and what a united European approach could unlock. Please welcome Professor Philippe Tibi.
I will talk about the European LP strategy, and I will start with a simple fact, is that capital decides outcomes. You know, in Europe, we have a lot of good universities, good scientists, we have a lot of entrepreneurs, but when a company becomes successful, when a European company becomes successful, they tend to not only look for US money, but also they are US controlled. And that's a big waste for us and for our citizens as well. So that's, I think it's a fact of life, and that's exactly what we want to change. And this is why I think the spin of the conference about capital is so important. And the thing is, I think all of us are aware of that today, but the thing is, how can we make this happen? The second idea I want to push forward is that for LPs, technology should be a priority. If you look at our history, in the 19th century, Europe was leading the world. You know about the British Empire, the French Empire. How come?
The German Empire.
Because these two countries, in the first place, historically, have promoted
Is it already special, or do I have to do anything?
And as a result of that, and in defense as well and military, they could be able to exert influence in many parts of the world. Today, the clock has turned. We have turned the clock. Now Europe is in the middle of between a rock and a hard place. We are faced with two increasingly unfriendly powers, the US and China, that master technology. And they know that technology is the source of power. And what makes things even worse for us, if we do nothing, is that artificial intelligence is not only a hype. Artificial intelligence is a general purpose technology that is very similar to the first and second industrial revolution, because while the latter were the domination of mechanical force, of mechanical energy, artificial intelligence, if that works, will master collective intelligence and will bring the same kind of productivity gains that we experienced in the last century. So, and it means also that that will be shareholders of this venture will get disproportionate return. So I think that's the very reason why LPs should be invested in technology, above the fact that, of course, MSCI TMT is more than 35% of the global capital market. Are we equipped to do that? Yes, I think Europe is equipped to do that. Europe, the savings of the households in Europe are about 35 trillion, north of that probably, euros. It's more than the US, actually, in terms of savings. The issue that we have is that we have savings, we don't have capital. And what we need to find is, or to develop, is a formula to transform savings into capital. Because as we know, since the great economist of the 18th century, and even since Karl Marx, the capital is a factor of production that needs to be employed in full force. So that has been made clear by many reports, starting with the Draghi reports, with frightened everybody because he was talking about 4 trillion euros in 5 years. But again, 4 trillion, if you compare to 35, is not a big deal. I think the mistake in this report is that it promoted public money, which I think is kind of no-go for many people. But we have a lot of private money. So the question is, how are we going to action private money there? The Cookies Noyer report that was delivered in Berlin last week is a strong encouragement to do that via private money, and I will extend a little bit on that. So, what is the? How can we do that? How did we do that in France? I think in France we had public action with private money. The public action was to sponsor the idea at the highest level in the country by the President of the Republic, Emmanuel Macron, to say technology is a good thing. And then we discussed with the insurers that managed 2 trillion in France as a way to persuade them, if I may say, to invest in this asset class, which is a legitimate asset class. That has worked. They have invested so far 14 billion euros in VC and public listed in public equity tech. Together, we have created a platform of 160 funds, 80% of that being VC. One quarter of this being first time, which I think is very good because there are the new energy that has come to us. We have 10 funds managing over 1 billion, which I think is the threshold to go after the big pockets of this world. And what is very important in our mind is that 80% of the money is invested in the EU and half of that only in France. So it's a truly European venture, and that was asked for diversity reasons by the LPs themselves. And the pillar to do that are, political backing. Quite important to put the story in the mind of the people, of the decision makers. It is alignment of interest. We told the LPs that they invest for the returns, not for patriotism. Nobody has been promoted for patriotism, under my knowledge, but for the returns that the team brought. It's governance, which is shared with and which is owned by the LPs, and it's about professional execution. So how can we do that in Europe? The thing we don't want to do is to bring with the French model. I think sometimes we have a reputation in France in giving lessons and lecturing the world. So certainly not in a Nordic country I would do that. What we propose is to create a platform where the willing LPs would meet and invest in VCs that operate in the EU, in different countries that are not bound by national geographies. So we have our initiative in France. The Germans have WIN. We have started discussing with the Germans to gather maybe 20 LPs. There will be 15 LPs that operates both in Germany and France, and it's a nice way to shed light on people that do Europe technology on a bottom-up mode. And this will be, if that works, that will be an open platform for other countries to work. We believe that ecosystems should be national, or will be national in the first place for many reasons. So we were told that it will be a long speech, and I always overspend 2 minutes. So I will conclude to say that we have a lot of reports that are very good, that we need some action. I will come back to my Marxist reference. I know that this is a capitalist country with a left spin in the Nordic, and I've always, and I apologize for those who have already listened to that, but I have one rallying cry, which is LPs of all European countries unite. Thank you very much.
Chris, I wanted to bring you on, and everyone should hear why. If I start with that framing, we just heard from Professor Tibi. Tibi has been absolutely instrumental in everything that really speaks to getting pension capital, getting insurance capital, as is the case in France, into venture. You've been a bit a similar role in the UK. Can you just describe the initiative that you're taking in the UK and where you've progressed to?
Absolutely. Hi everyone, Chris Elphick from the British Private Equity Venture Capital Association. Been working on this for a number of years and a lot of inspired by the great work that Professor Tibi has done. You know, the British were not too modest to take inspiration from France on these things, as we shouldn't be. In a similar way, so as an association for private equity and venture capital funds, we've been tracking for years how, you know, basically, especially in venture, it's one consistent thing when it comes to pension fund investment, institutional investment into UK venture. It's been consistently 0 or 0.000 something every year for the last decade. And while, you know, 10 years ago, everyone thought, well, that's fine. Who cares where the money comes from? I mean, you know, the UK is the third largest venture ecosystem in the world, and, you know, it's been as high as 2/3 of the capital that our VC funds have raised has comes from overseas, which is great, right? You know, we're attracting inward investment. That's all great, isn't it? But I think, especially as we're talking about, you know, thinking around tech sovereignty, you know, and our own independence. You know, especially in the last few years, we've been thinking, okay, that probably needs to change, because not only from a commercial perspective, all the upside of these brilliant, you know, returns that our members generate are going to teachers in Canada and to US endowment funds and to LPs in the Middle East. We're not, as a nation, getting the upside of this fantastic industry. And then the other side of that is also, you know, especially at the later stages of venture, the UK, even though we have a fantastic, you know, seed Series A ecosystem in particular, at the later stages, we don't have the funds to pick up that investment and scale our companies and keep them in the UK and in Europe. You know, and I'd want personally, you know, the UK to be doing, you know, seen as a, you know, UK and Europe, you know, UK being part of the European ecosystem more and more again. That you know, that we have the scale and the ability to keep those companies in the UK and not be, you know, we've had an easy out for years, the last 10 years of, you know, seeding these amazing companies and then selling them to the US and listing them in the US, and you know, it's been nice, but that I don't think is gonna cover it much longer. So, sorry, to get to the actual point of your question. So in the UK we've had a series of reforms which has meant that the large pension schemes in the UK have agreed to put 5% of their assets into private markets, and, you know, we want a good proportion of that going to venture. At the moment, it's gone from 0% to 0.007%, I think, according to the Atomic Data European Tech Report, which is progress of a kind. But I'm hoping to see more of that money coming through this year, and I understand lots of VCs are speaking to pension funds in the UK. There are lots of problems, both regulatory and culturally, which we're trying to overcome, but I'm confident we'll start seeing more of that money coming.
Can I ask you both a question that we're all pensioners in here at some point. We all just want, in the end, a good, solid pension that can actually provide for our future. Is there any problem between, you know, is there a dichotomy? You have to, if you want returns, you have to go to the States. If you want to back Europe's future, you'll go to Europe. Is that a true statement, or is that completely false?
I don't think so. I think the LPs in France that are not very much invested in the US either, for maybe a not so wise reason, which is to say our liabilities are in euros, so we prefer to invest in euros anyway. So, I mean, in modern finance, there should not be that an issue, but that's a fact. So I think the issue is much more against generally reluctance to invest in technology at all stages than Europe. It's just they don't, you know. I think it's a vicious circle. If you don't know an asset class, you don't invest in the asset class. If you don't invest in the asset class, you don't know the asset class, and on and on. So because the asset class is small in the world, maybe 2-3% of the world, some LPs believe that it's not, it's avoidable. It's too much of a hassle for something which will not move the needle. Personally, I think it's not the best fiduciary alignment with the savers, because the theory tells them to invest in all legitimate asset classes, and VC is a legitimate asset classes that has produced the Amazon, Meta, Nvidia, and the like. You know, all the big US tech firms have been funded by VC at some point. So I don't see any asset class that can be more legitimate. And the fact that it's risky is, in my view, is not a problem, because the portfolio, there are some volatile asset classes, some that are not volatile, but the portfolio risk is reduced by diversification, which is also a 101 lesson in finance. So if you miss a legitimate asset class, you miss an opportunity to reduce the risk of the portfolio.
Really quickly, I want to ask both of you, and this is the final question we'll make it to cover here. I want to ask you, what are the steps we got to take across Europe, and what steps are being taken when it comes to getting more institutional capital into venture and tech?
You know, I think the steps, one side is institutional, driven by the EU and Capital Market Union, 28th regime, and the likes, which is very important, but that will take years. So I think we don't have the time to wait, because the geopolitical forces are not waiting, and we lose weight by the minute. So we need to be active. I think my view, that's very personal, is that we must start in countries in the first place with the ecosystem, because the ecosystem are made from people that meet with each other, but they don't only meet, they trust each other, and they report to some extent to public authorities in each country. So I think that is the ecosystem. And the ecosystem is institutions and people. I think that in every country, I would welcome that in every, and everybody here, I think, would welcome that in every country there are forces that influences the public authorities and the LPs to take a look. It's only take a look, do the homework, and work the other way around. Justify why you do not invest in venture. That's how we should be, I think, how the problem should be set. So I think that that's really a national push, especially because defense is also in the equation, and that's by definition very national. And then, or in parallel, we must bridge to get the critical mass, because Europe is a continent of a considerable wealth, a GDP that is the second in the world, and our competitors, they are continents. So Germany is not going to save the day, France is not going to save the day, the Nordics, despite all their qualities, are not going to save the day. So we need to work together and find common grounds, because you don't order people to work together. You need to find the right alignment of interest. And we must, because it's finance, and it's all about interest. And I think there is an alignment of interest, which is that the companies in all our countries will be better funded. You know, the reason why, as a French, I've been to maybe Poland 6 times in the 15 months, or Germany, or here in the Nordic, which is a privilege, is that I think that if there is better VC funding in all these countries, it will be better for the French companies, which is the purpose of the French government by definition. So that's a win-win. And that's why every country, even those without a financial ecosystem, should find a benefit in it, because it will fund their companies. So even the companies that are very late on finance, you see Romania, for instance, they have been funded by, they have very successful startups that have been funded by US funds. So their choice is, are you going to be funded by the US or by European VC? And I think the choice should be obvious today.
Chris,
yeah.
with a counter that's already 20 seconds beyond. I'll give you the last.
I endorse all of that, and I would just add, from the UK perspective, I think getting the balance right. How much carrot, how much stick do we have to sort of turbocharge it and make this happen? Because, as I said, we're coming from a standing start, or a lot of countries are, where it just hasn't happened before, so it's not going to happen overnight. So patient to an extent, but also, the need to see this happening, because at the moment, we're seeing that next wave of technology coming through, and 11 Labs and others, we're seeding them and putting the Series A in the UK, and then who steps in, putting 100 million, rounds in every couple of years. It's the big US funds who keep stepping in. So until we can, we need to just try and challenge that and make sure that doesn't happen, because at the moment, it does seem like we're not as aligned, especially in areas like defence. It is now a national strategic priority, I think, and you're seeing that in European governments, and we need to be as joined up as we can to change that.
And I would say to everyone in the audience, you're all opinion makers. We actually can move the needle if we come together to try and influence the people that are in power, both in the regulatory space, but also in our pension funds, to move towards more money for our European tech ecosystem. Venture is relearning an old lesson. Time matters more than timing. Long-term capital is being tested on patience, governance, and conviction. Christina Brinck from Volvo Group Venture Capital, Daniel Keiper-Knorr from Speedinvest, and Joe Schorge from Isomer Capital operate at that edge, across corporate, institutional, and evergreen capital. They'll unpack what it really takes to succeed as a long-term venture investor today. Please welcome Christina Brinck, Daniel Keiper-Knorr, Joe Schorge, and moderated by myself, Andreas Monkholm, co-founder of EUVC. I'll open with the question that we come from this very wide perspective of what can we do as a society. If we look at the allocation level, I'd love to ask, if we start with you, Joe, I'd love to ask you, how do you think and how do you vet managers across Europe in a way where you are able to allocate as consistently as you've done and with as much success?
Well, the exciting thing about Europe is that great tech companies are coming from everywhere. Literally every company in Europe has multi-unicorns now, which is great. The problem with Europe is that literally every country is creating great things. So how do you deal with that? I think our approach is to try to meet everyone. It's a lot of work. We fly to every single country, we try to meet every VC fund and understand where is the market opportunity, what's their strategy to approach that opportunity, and what's the experience of the team to execute that strategy. I think there's a three-leg stool of any private fund. Exciting market opportunity, strong strategy to approach that, to generate return, and then strong team to execute that strategy. In Europe, a lot of the VC community is quite young and new, so you can't apply the track record analysis that you can in other asset classes, right? There isn't 40 years of history. Most of the system rebooted after the financial crisis. So you've got to go to first principles and meet the people and understand what is their experience, how do they execute. And if you do that, it's the most... I think Mr. Tibi said legitimate asset class. If you look at long-term numbers, it's the highest performing major asset class in big statistics. But the dispersion of returns is high, right? When you invest in a company, you may lose your money, you may make 100x. The range of outcomes is unbelievable. So I believe diversification is the way to take the risk out of that. And so far, that's why we run large diversified portfolios for institutions, and that works very well. So every day of the week, we're making money, and every day of the week, we're losing money. But that's the nature of building business.
Coming up on almost 100 fund investments, quite significant. Yeah. Christina, you've invested as a pension fund manager before. Now you're doing so on behalf of Volvo Group. Mm-hmm. What Joe just said, does that resonate? Is that how you think about it?
Yes, I think I agree. And I think it's very different to change role as an LP, being a financial LP, looking for one type of fund investments, and now being more a strategic LP, looking for another type of investments. And our main strategy is direct investments, but we also have a small fund program. And in this fund program, we are looking for managers that in some way fits into our industry and can drive the growth and the innovation in our industry.
How does a fund investment complement your direct investments?
I see it mostly from a portfolio perspective, because the direct investments are Series A and beyond, and for the funds we can reach the true venture type of returns with seed and early A. And that type of investments are difficult for us to make as a direct investments. These companies are typically too small and too young to be able to collaborate with large customers or partners like Volvo and other in the industry. So it's a way of combining our create early interest across Volvo Group for what type of innovation that is happening across the industry.
Yeah, it's a bit of a very good looking glass into the future as well.
Yes, yes. And also the type of relationship that I had as an LP representing large institutional capital, that is different compared to today, because now we have more a continuous dialogue. We help the funds in their due diligences and their sourcing, and we can also potentially work together with the portfolio companies. So we have a much more active conversation with the funds that I invest in today.
Yeah. Daniel, representing the other end of the ecosystem, so to say, you're one of the GPs out there raising. You've done that for a long time and you've been massively successful. Tell me a bit about where you're seeing LPs that you're meeting in Europe, and not only talking about the institutionals, but also the likes of the group that we have here, family offices, wealthy individuals that are looking to invest in funds. What do you see them do well or maybe do less well when it comes to thinking about fund investments?
Interesting question. Not so easy to answer. What I see them doing well is that they invest at all, right? That's the first, and it's way too little out there actually allocating in a way that the asset class is deserving for not only the LPs, the GPs, and the portfolio companies that we are investing in, but the wider economy and public. What I think most people struggle with when assessing venture as a part of their portfolio allocation is the long-term characteristics of it. It's probably the asset class with the longest insecurity of the outcome, that you have to wait for like 5-6 years to have an idea of your LP ticket. Will it do well? Will it do not so well? How will it do it after all? And then truly understanding the power law effect. Yeah. That's something that's so fundamentally not in our human, DNA and brain. We always assume things go linear, and they don't. Yeah. And in venture in particular, this is where this is most visible, and yet most difficult still to understand. So if I would wish not only the LPs but also the GPs properly understand, is the power law effect. Yeah. It's everywhere. Everything in the end is a hit-driven business. In professional sports, you only see the top 0.1% actually make it into the limelight, and all those others on the way there get hurt or are less fortunate. You don't see. In business, it's no other than in venture.
Yeah. Joe, if I can switch to you, because you're obviously also, and oftentimes you're raising from families that are investing alongside you as well, so to say, with a lot of LP commitments themselves. What are you like? I imagine that as a professional capital allocator, you might sometimes feel like you want to bang your head. We'll stick with Daniel.
As much as I understand their urge to do so, if I'd be really honest, just don't prior Series C. because the likelihood of the investment to fail is just so big.
Yeah.
I mean, we run an investment team of nearly 30 people. 30 people across 5 offices that do nothing else but sourcing, scouting, fighting for allocation, and then managing the portfolio.
Yeah.
This is 30 hopefully highly skilled people. Comes also at a significant budget. Yeah. These are offices in Berlin, Munich, Paris, and London, and Vienna. Among some not the cheapest workplaces. That requires significant financial and personal effort to really build and actually run a portfolio, and yet we calculate with a 60% loss rate.
Yeah.
So if you, do probably 3 investments, you may expect 1 to work, and still you don't know if it's a massive outcome to justify the risk and the money at risk that you put in.
Yeah. Can I, if I ask the two of you, if you were to give one final piece of advice to people wanting to allocate more to venture, what would be your advice? If we start with you, Christina.
Yes, I think if you consider invest in venture, you probably have more capital available in other asset classes, and I think you will become a better investor in the other asset classes if you invest in venture, because you start to understand the tech, the pace of development, and often you can see that a venture company, early stage, quite soon ends up in your buyout portfolio. So I think you will become a better investor in general by being active in venture.
Great, beautiful.
Yeah, it always strikes me, none of us are using less technology year on year, right? It's literally in everything we do, driving your car and so on. So as a longer term trend, you must and you will invest in technology, whether it's through buyout or whatever. I think the power law point, and it ties with my earlier point, which is you must have patience, as you said, but you must diversify because it's a hits business, as you said, and diversification is the way you control for that risk. But my advice, if you haven't yet invested in venture capital, think about entering through secondaries. I mean, that's a really interesting play on Europe right now because we've had 15 years of guys like that building amazing stuff.
And there is a lot of supply at the moment.
And there's good supply, and there's not a lot of demand. So what I mean is you can buy in as LPs are tired. So some of these families who put money in 10 years ago, they haven't had enough back. So this is an interesting moment where you can build a portfolio with kind of accelerated velocity and then do primaries together, and they work well, which is well known in buyout, right? We do that in buyout strategies, but not enough people do that in venture.